Good evening, everyone. Welcome to what I believe will be an absolutely transformative learning experience. Tonight, we're embarking on a comprehensive journey through the intricate world of proprietary trading firm rules, a topic that, whilst it may sound technical at first blush, is absolutely fundamental to anyone who's serious about pursuing a career in funded trading. Now, you might be wondering, why should I care about all these rules? Well, let me tell you, understanding these regulations isn't just about compliance, it's about survival and success in this industry. We're talking about the difference between walking away with substantial profits or watching your trading account disappear overnight. What we have before us is the complete guide to prop firm trading rules, covering both Forex and futures markets, and encompassing everything from demo evaluation accounts right through to fully funded live accounts. This isn't just theory, mind you. This is practical, actionable knowledge that will serve you throughout your entire trading career. So, what exactly will we be exploring together this evening? Well, buckle up, because we've got quite the roadmap ahead of us. We'll be diving deep into drawdown rules, absolutely crucial for managing risk. We'll examine profit targets, trading day requirements, and those fascinating consistency rules that separate the professional traders from the gamblers. We're going to look at leverage restrictions, because let's face it, leverage is both your greatest tool and your most dangerous weapon. We'll cover position holding policies for weekends and overnight positions, news trading restrictions that can make or break your account, and lot size caps that keep you from overextending yourself. But that's not all. We'll also be examining expert advisors and automated trading systems, copy trading rules, hedging policies, and this is particularly important, all those prohibited strategies that will get your account terminated faster than you can say arbitrage. And because we live in the real world where money matters, we'll thoroughly discuss payout structures, withdrawal rules, profit split arrangements, time limits for evaluations, the various evaluation models different firms use, what happens when you violate rules, how scaling plans work when you're successful, and the sophisticated compliance and monitoring systems that firms use to keep everyone honest. This is comprehensive education at its finest, ladies and gentlemen. By the end of this presentation, you'll have a crystal clear understanding of the entire landscape of proprietary trading regulations. You'll know exactly what's expected of you, what's forbidden, and how to navigate this complex world with confidence and competence. So, let's roll up our sleeves and get to work. This is going to be brilliant. Right then, let's start with the fundamentals. What exactly is a proprietary trading firm? Well, in its simplest form, a prop firm is an organization that funds traders after they've successfully passed certain evaluations. Now, here's the crucial bit. The capital always stays with the firm. You're not putting your own money at risk here. You're trading with their capital. These firms offer access to a wide range of instruments, depending on their specific focus. Forex pairs, futures contracts, stock indices, precious metals like gold and silver, cryptocurrencies, and even individual stocks. The variety really does depend on which firm you choose. Now, the journey typically follows a two-stage process. First, you've got your evaluation phase. This is where you trade on a demo account, proving your capabilities without risking real money. Then, if you pass, you move to the funded stage. Here's where it gets interesting. You're trading either with live capital or, in some cases, a simulated profit and loss system. But, and this is absolutely critical, you receive real payouts based on your performance. So how do these firms make their money? Well, it's rather ingenious, actually. They monetize in two ways. First, through challenge fees that traders pay to attempt the evaluation, and second, by taking a share of the profits that successful traders generate. It's a symbiotic relationship, really. But why do all these rules exist? You might wonder why prop firms are so stringent with their regulations. Well, there are several compelling reasons. Capital protection is paramount. They need to safeguard their investment. They're also ensuring consistent risk management across all their traders. Fair execution is essential to maintain market integrity. And finally, scalability. They need systems that work whether they're funding 10 traders or 10,000. Understanding this business model is absolutely fundamental to everything else we'll discuss. It contextualizes why every single rule exists and why compliance is so crucial to your success in this industry. Now we're entering what I consider to be the absolute cornerstone of prop trading, drawdown rules. If you master nothing else, master this. These rules are the very foundation of risk management, and they will make or break your trading career. Let's break down the 4 primary types of drawdown rules you'll encounter. First, we have daily drawdown. This is the maximum loss you're permitted to sustain in a single trading day, typically ranging from 2 to 5% of your account balance. Think of it as your daily safety net. Second, there's maximum or static drawdown. This is a fixed floor, usually between 4 and 10% of your starting balance, and it's the absolute minimum your account can drop to. This threshold never moves, regardless of how much profit you make. Third, and this is where it gets particularly sophisticated, we have trailing drawdown. This is a dynamic threshold that moves upward as your equity peaks increase. But here's the key: it never moves downward. It's designed to lock in your gains whilst still giving you room to trade. And fourth, we have end-of-day drawdown, or EOD for short. With this system, your thresholds adjust only at session close, typically 5 o'clock Eastern Time. Your intraday fluctuations don't matter. Only where you end the day counts. Now, there's also an important distinction in breach types. Some firms track intraday breaches, meaning you can breach at any moment during the trading session, whilst others only care about end-of-day violations. Additionally, some firms track realized balance only, that is, only your closed trades, whilst others include unrealized profit and loss from your open positions. Understanding these distinctions is absolutely vital. The type of drawdown system your firm uses will fundamentally affect how you manage your trades and your overall trading psychology. Right, let's dive into the mathematics of daily drawdown. Don't worry, it's not as complicated as it might seem, but precision here is absolutely essential. The first method is balance-based calculation. The formula is delightfully straightforward. Your daily loss limit equals your starting balance multiplied by your daily loss percentage. Let me give you a concrete example. Say you've got a $100,000 account with a 5% daily limit. 5% of $100,000 is $5,000, which means your equity must stay at or above $95,000 throughout the entire day. Simple enough, yes? Now, the second method is equity-based calculation, and this one's a bit more interesting. Here, you take the higher value of either your starting balance or your starting equity. Let's say your balance is $100,000, but you've got an open trade that's currently profitable, bringing your equity to $101,000. The calculation would use $101,000, the higher figure, multiply it by 5%, giving you $5,050 as your daily limit. This means your equity must stay above $95,950. The third method is the end-of-day calculation. And this is quite different. It uses only your previous day's closing equity. If you closed yesterday at $102,000 with a 5% limit, today's minimum equity at close must be $96,900. Notice the key difference. Your intraday movements are irrelevant. Only your closing equity matters. Now, some critical notes to remember. These limits reset daily, typically at midnight broker time. Floating losses, that is, unrealized losses on open positions, usually do count toward your daily limit at most firms, and some firms offer buffer calculations that exclude overnight positions from the daily calculation, giving you a bit more breathing room. Understanding which calculation method your firm uses is absolutely paramount. It fundamentally changes how you manage your risk throughout the trading day. Now let's examine maximum drawdown, also known as static drawdown. This is your absolute floor, the line in the sand that must never be crossed. The definition is quite precise. It's the absolute minimum equity threshold that never changes, regardless of your account's performance. The formula is equally straightforward. Your violation level equals your starting balance minus your starting balance multiplied by the drawdown percentage. The typical range you'll encounter is 4 to 10% of your starting capital. Different firms have different appetites for risk, you see. Let me walk you through a comprehensive example. Imagine you start with a $100,000 account and an 8% static drawdown. 8% of $100,000 is $8,000, which means your violation level sits firmly at $92,000. That threshold never, ever moves. Now watch what happens as your account performs. On day 1, your account grows to $105,000. Brilliant. But notice, your drawdown threshold is still $92,000. It hasn't budged. However, your available loss buffer has now grown to $13,000. That's the difference between your current equity of $105,000 and your floor of $92,000. By day 15, perhaps your account has dropped to $98,000. Your threshold? Still $92,000. It never changes, remember? Your buffer is now $6,000. Fast forward to day 30, and you're sitting at $93,500. The threshold remains at $92,000, unchanging as ever, and your buffer has narrowed to just $1,500. You're getting dangerously close to a breach. What are the advantages of static drawdown? Well, it's simple and predictable. Absolutely no ambiguity whatsoever. It provides more room as your profits grow, since the floor stays put whilst your account rises. And it's particularly better suited for swing traders who need wider buffers to accommodate natural market fluctuations. The disadvantages? It doesn't protect your locked-in profits. Once you've made gains, there's no mechanism preventing you from giving them all back as long as you stay above that original floor. And somewhat paradoxically, it can encourage riskier behavior after early gains because traders feel they have so much more room to maneuver. Static drawdown is brilliant for its simplicity, but you must have the discipline to protect your profits yourself because the rule certainly won't do it for you. Now we come to trailing drawdown. In my opinion, the most sophisticated and psychologically challenging of all the drawdown mechanisms. This is dynamic risk management at its finest. The master formula is elegantly simple. Your trailing level equals your peak equity minus your allowed loss amount. But here's what makes it special. Unlike static drawdown, this threshold actually moves as your account grows, always maintaining that fixed distance below your highest equity point. There are two primary types you'll encounter. First, intraday trailing drawdown, which updates continuously throughout the trading session. Every single tick counts here. Even unrealized profit spikes immediately lock in higher thresholds. This is the most restrictive type. If your equity hits 105,500 even for just 1 second, your drawdown instantly locks at that peak. Second, we have end-of-day trailing drawdown, which updates only at market close. Your intraday spikes are completely irrelevant. Only your closing equity determines the adjustment. This is far more forgiving for volatile trading styles. There's also an important distinction between realized and unrealized balance tracking. Realized balance trailing means only your closed profits adjust the trailing threshold. It encourages you to actually take profits. Unrealized balance trailing, on the other hand, means floating profits immediately lock in higher thresholds. This can be rather punishing if those large unrealized gains subsequently reverse. Let me give you a detailed scenario with a $50,000 account and a $3,000 trailing drawdown. That's 6%. On day 1, you start with your balance at $50,000. Your highest peak is $50,000, and your trailing level sits at $47,000. Your distance to breach is $3,000. By day 3, you've made a lovely $2,000 profit. Your balance is now $52,000. That's your new peak. So your trailing level adjusts upward to $49,000. Notice your distance to breach remains constant at $3,000. The buffer never grows. On day 5, you hit a rough patch and lose $1,500. Your balance drops to $50,500. But here's the crucial bit. Your peak remains at $52,000 because peaks don't decrease. Therefore, your trailing level stays at $49,000. Your distance to breach has now shrunk to just $1,500. You're in dangerous territory. By day 8, you've had a brilliant run, and your account jumps to 54,500. This is your new peak, so your trailing level moves up to 51,500. Your safety buffer returns to $3,000. Then on day 10, you take another loss, dropping to 52,500. Your peak, still 54,500. Your trailing level, still 51,500. And your distance to breach is now just $1,000. One more bad trade and you could breach. Finally, by day 12, you've recovered brilliantly and reached 59,000. New peak, your trailing level rises to 56,000 and your buffer resets to $3,000. What are the advantages? It systematically locks in your gains as you profit. The disadvantages? It can tighten very quickly on equity spikes, especially if your firm uses unrealized balance tracking. And psychologically, it's far more demanding than static drawdown because your threshold is constantly rising. Trailing drawdown rewards consistent profitability but punishes volatility. It's designed for disciplined traders who can steadily build their accounts whilst protecting their gains. Let's now discuss end-of-day drawdown, commonly abbreviated as EOD. This is a rather elegant solution to some of the challenges posed by intraday drawdown tracking. The fundamental principle is brilliantly simple. Updates occur only after market close. Your intraday swings, no matter how dramatic, simply don't move the limit until the session ends. This is typically set at 5 o'clock Eastern Time for most markets. You'll encounter several common setups. First, there's EOD trailing drawdown, where the threshold adjusts upward if you achieve new profit highs at close. Second, EOD static stop, which trails upward but stops once it reaches a predetermined cap, often your starting balance. And third, daily liquidation value resets, where your risk threshold resets to a fixed liquidation value each morning until market close. What are the benefits? Well, they're rather substantial. Lower stress intraday is the most obvious. You can tolerate swings during the trading session without constantly worrying about breaching. You get fewer false breaches from temporary spikes during high volatility periods, and it's particularly swing-friendly, making it ideal for traders who hold positions across multiple days. But there are risks we must acknowledge. The primary danger is the temptation to over-leverage intraday. Because only your close matters, some traders might be inclined to take excessive risks during the day, thinking they can simply close out before 5 o'clock. This is dangerous thinking and has ruined many promising trading careers. EOD drawdown is particularly common in futures prop trading models and is increasingly appearing in some Forex evaluations as well. It's a more forgiving system in many ways, but it demands discipline. You must still trade responsibly throughout the day, even when your intraday fluctuations don't immediately affect your drawdown status. Now we turn our attention to profit targets, the benchmarks you must achieve to prove you're not just avoiding losses, but actually generating returns. Typical profit targets range from 6 to 15% of your account balance overall, depending on which firm and which evaluation model you're working with. Let's examine the various phase structures. In one-phase evaluations, you're looking at a single target, typically 8 to 10%. These are simpler, more straightforward challenges. Two-phase evaluations are more common and break down like this. Phase 1 requires 8 to 10% profit to advance, whilst Phase 2 drops to a lower verification target of around 4 to 5%. This second phase is designed to confirm that your Phase 1 performance wasn't just luck. Some firms use three-phase evaluations with progressively lower targets, perhaps 10% in Phase 1, 5% in Phase 2, and 3% in Phase 3. These multiple phases emphasize consistency checks at every stage. The master formula is delightfully simple. Your required profit equals your starting balance multiplied by your target percentage. Let me walk you through a concrete example with a $100,000 two-phase challenge. In Phase 1, with a 10% target, you need to generate $10,000 in profit to reach $110,000. Once you pass to Phase 2, you're starting fresh with that $110,000 balance, and you need 5% of that, which is $5,500, bringing you to $116,100. Critical notes to remember: you must hit these targets without violating any other rules, drawdown limits, trading days, consistency requirements, all of it. Additionally, unrealized profits typically don't count toward your targets. Your trades must be closed to register as actual profit. And finally, most experienced traders focus on steady, methodical growth rather than rushing to hit the numbers, because overtrading to reach targets quickly is one of the most common causes of evaluation failure. Patience and discipline are your greatest allies when pursuing profit targets. Minimum trading days requirements are absolutely essential to understanding prop firm evaluations. This rule exists to prevent what I call the one lucky trade syndrome. The ranges vary considerably across firms. Express or instant challenges might require just 2 to 3 trading days. Standard challenges typically require 3 to 5 days, and strict firms may demand up to 10 trading days before you can pass their evaluation. But what actually qualifies as a valid trading day? At its most basic, it's any day where you've opened and closed at least one trade. However, many firms add additional requirements. Some insist on minimum profit thresholds. For instance, you must make at least $50 that day for it to count. Others require a minimum profit percentage, such as 0.5% of your initial balance. The more advanced rules can be quite specific. Some firms require that your trade size be at least 5% of your initial balance, and that the profit or loss from that trade must be at least 1% of the trade value itself. These requirements ensure you're not just opening tiny positions to satisfy the day count requirement. Let me give you a practical tip. Use small, planned trades to systematically accumulate your required trading days. Open a modest position. Say 0.1 lots if you're simply seeking to satisfy the day count, as long as it meets the firm's minimum thresholds. And here's a common source of confusion that I must clarify. Do not confuse calendar days with trading days. If you take the weekend off, which most sensible traders do, those don't count toward your requirement. Only days where you actually execute trades count toward your minimum trading days. This requirement ensures that firms are funding traders who demonstrate consistency over time, not just those who got lucky with a single brilliant trade. The consistency rule is absolutely fascinating from a psychological and risk management perspective. Its purpose is to prevent traders from relying on one extraordinarily lucky day to pass their evaluation. The definition is precise. Your best single day's profit must not exceed a specified percentage of your total profit since your last payout. Common thresholds vary widely. Very strict firms might impose a 15% rule. Standard implementations use 20 to 30%. More lenient firms allow 40 to 45%, and the most common threshold you'll encounter is 50%. The master calculation formula is this: your minimum total profit required equals your best day's profit divided by the consistency percentage. Or, to rearrange it, your best day profit percentage equals your best day profit divided by your total profit. And this must be less than or equal to the consistency rule percentage. Let me work through 2 examples to make this crystal clear. Example 1. Using a 50% rule. Say your most profitable day netted you $1,000. 1,000 divided by 0.5 equals $2,000. That's your minimum total profit required. So if your total profit is currently $1,800, you cannot withdraw yet. You need another $200. But if your total profit reaches $2,500, then your $1,000 best day represents only 40% of your total, and you're clear to proceed. Example 2. Using a much stricter 20% rule. Your most profitable day was $2,000. 2,000 divided by 0.2 equals $10,000 required. This is exceptionally strict. You need to generate $10,000 in total profit before that $2,000 day represents merely 20% of your total. Here's the crucial bit about application. Some firms apply this rule only during the evaluation phase. Others apply it only on funded accounts, and some apply it to both phases. You must verify your specific firm's policies. Let me illustrate with a realistic trading scenario using a 40% consistency rule. You've achieved a $10,000 profit target. Your daily breakdown looks like this: Monday 4,000, Tuesday 3,000, Wednesday 2,000, Thursday 500, Friday 500. Your total is $10,000. Your best day was Monday at 4,000. 4,000 divided by 10,000 equals 40%. You've passed, just barely, right at the 40% limit. Now watch what happens if we violate the rule.
Your best day is $6,000, and your remaining days total only $1,000, giving you $7,000 total. 6,000 divided by 7,000 is 85.7%. This is a catastrophic breach. You've relied far too heavily on that one brilliant Monday. Here's my teaching strategy for helping students master this. Track your best day's profit daily and immediately calculate your required total using this formula. Best day multiplied by 1 divided by the consistency percentage equals your target total profit. And here's a practical tip that often surprises traders. If you have a big winning day early in your evaluation, you've essentially raised your profit target significantly due to the consistency rule. That spectacular $4,000 day might feel brilliant, but it means you now need substantially more total profit before you can request a payout. It's both a blessing and a burden. Leverage restrictions are absolutely critical to understand because leverage, whilst being one of your most powerful tools, is equally your most dangerous weapon if misused. Let's examine the typical maximum leverage ratios by asset class. For Forex major pairs, you're looking at 1 to 30 up to 1 to 100 leverage. This means with a $10,000 account and 100 to 1 leverage, you could theoretically control $1 million in currency. Quite extraordinary, really. For futures contracts, leverage is typically lower, ranging from 1 to 20 to 1 to 50. But remember, futures contracts already have inherent leverage built into their structure, so you're dealing with substantial exposure even at these seemingly modest ratios. In the stock market, US regulations dictate 1 to 4 leverage for day trading and 1 to 2 for overnight positions. Pattern day trader rules apply here as well, so be mindful of those requirements. And for cryptocurrencies, given their extreme volatility, leverage is limited to 1 to 2 or 1 to 5 at most prop firms. This is prudent risk management, given how violently crypto markets can move. Now, here's the crucial distinction between maximum leverage and effective leverage. Maximum leverage is what your broker allows, what's theoretically possible. Effective leverage is what you actually use in practice. And this is where professional traders distinguish themselves from amateurs. Let me give you a practical example. You have a $100,000 account with 100 to 1 maximum leverage available. You open a $200,000 position. That's 2 standard lots. Your effective leverage is only 2 to 1, far safer than the 100 to 1 you could have used. The professional approach to position sizing doesn't start with leverage, it starts with risk percentage. The formula is position size equals your account risk in dollars divided by your stop loss in pips multiplied by the pip value. Here's a concrete example. You have a $50,000 account. You're willing to risk 1%, that's $500 on a trade, with a 25 pip stop loss, and the pip value is $10 per pip. Your calculation, $500 divided by 25 pips equals $20 per pip. At $10 per pip, that's 2 standard lots. Notice we derived this from risk percentage, not from maximum available leverage. The cardinal rule: never let maximum leverage dictate your position size. Always use your risk percentage first, then verify you're within the lot caps and leverage limits. This approach will save you from the catastrophic losses that destroy so many trading accounts. Position holding policies determine whether you can keep trades open over weekends or must close them by Friday's market close. This seemingly simple policy has enormous implications for your trading strategy. Weekend policies vary dramatically across firms. Some impose strict no-holding rules. You must close all positions by Friday's close to avoid potential breaches from weekend gaps. These firms are protecting themselves from the significant risk of adverse price movements when markets are closed. Others offer conditional weekend holding, where it's allowed only during certain stages, perhaps during evaluation,
but not on funded accounts, or vice versa. These firms might also impose risk restrictions, such as requiring reduced position sizes or tighter stop losses for weekend holds. And some firms are fully permissive, allowing weekend holding with no restrictions whatsoever. But even with permission, the risks remain yours to manage. Why is weekend holding risky? Well, several reasons. Market gaps caused by geopolitical events over the weekend can be devastating. There's a lack of liquidity. If something goes wrong, you can't exit your position. And unpredictable news events can move markets dramatically by the time they reopen Monday morning. For overnight holding during weekdays, most prop firms do allow it, though swap fees, also called financing charges, typically apply. These are the costs of holding leveraged positions overnight. Some firms restrict overnight holding during certain evaluation phases to manage their risk exposure, but generally, weekday overnight holds are permitted. If your firm allows partial position management, here's a sensible strategy. Close part of your position on Friday, perhaps half or 2/3, and hold the remainder with proper risk management in place. This way, you're protecting most of your profit whilst still maintaining some exposure to potential weekend moves. My recommendation is quite straightforward. If you're risk-averse or trading with a firm that has strict breach rules, close before the weekend. If your firm permits holding, and you have proper risk management, tight stops, reasonable position sizes, you might consider holding, but always document your rationale. Never hold over a weekend simply because you forgot, or you're hoping for the best. That's not trading, that's gambling. News trading restrictions are among the most misunderstood and frequently violated rules in prop trading. Pay very close attention to this section. The most common restriction is the time-based blackout window. Typically, this is 2 to 5 minutes before and after high-impact economic news releases. During this window, you are prohibited from opening or closing positions. Let me give you a specific example. Non-farm payroll data is scheduled for release at 8:30 Eastern Time. With a 2-minute blackout rule, you cannot open or close any trades between 8:28 and 8:32. The calculation is simple. Scheduled release time minus 2 minutes for the start plus 2 minutes for the end. High-impact news events are typically classified as red folder events on economic calendars like Forex Factory. These include non-farm payroll, consumer price index, gross domestic product reports, Federal Reserve announcements, European Central Bank rate decisions, and major central bank policy statements. The consequences for violations can be severe. Some firms will simply remove profits from any trades opened or closed during blackout windows. Others issue soft breaches, warnings with profit deductions, but your account continues. And some firms treat it as a hard breach, terminating your account immediately. Now, there are variations in how strictly firms apply these rules. Some progressive firms allow unrestricted news trading throughout. They're essentially saying, trade at your own risk. Some allow it during evaluation, but implement restrictions once you're funded. And some firms offer news trading add-ons. You pay an additional fee for the privilege of trading during news events. An interesting case is FTMO, which allows restriction-free news trading during your evaluation, but implements 2-minute blackouts once you receive funding. You must understand your specific firm's policies. Why do these restrictions exist? Primarily to prevent exploitation of broker feed delays during high volatility events. During major news releases, price feeds can become asynchronous across different liquidity providers, and some traders attempt to exploit these millisecond delays for risk-free profits. Firms quite rightly prohibit this, as it's not genuine market analysis. It's technical arbitrage. My advice: mark your economic calendar religiously. Set alerts for 15 minutes before red label events. Close any positions you're uncomfortable holding through the news. And if you must trade around news, do so well outside the blackout windows. The profits from news trading are rarely worth the risk of account termination. Lot size and position size caps exist to protect both you and the firm from over-leveraging. These are hard limits that, if exceeded, can result in immediate violations. Firms implement tiered lot caps based on account size. As your account grows, your permitted lot sizes scale proportionally. For instance, Forex pairs might range from 0.6 lots on a small account up to 24 lots on a large account. Gold, XAU USD, typically ranges from 0.1 lots to 4 lots. Indices might be 0.3 to 12 lots, and cryptocurrencies, given their volatility, often have higher numerical caps, but represent similar dollar risk, 5 to 200 lots. These caps vary by asset class because different instruments have different pip values and volatility characteristics. A one-lot position in Forex is vastly different from a one-lot position in cryptocurrency. Violations of lot size limits are taken very seriously. Exceeding caps may result in having your profits voided from the violating trades. Your account might be reset, forcing you to start the evaluation again. Or, in severe cases, you could face account termination, with potential permanent bans. Here's the best practice for position sizing. Compute your size from risk percentage first, never from the maximum lot cap. Then, confirm you're within the asset's lot cap limits. Let me walk you through an example. You have a $100,000 account. You're willing to risk 0.5%. That's $500 on a trade. Your stop loss is 50 pips, and the pip value is $10 per pip. Your calculation: $500 divided by 50 pips equals $10 per pip. At $10 per pip for a standard lot, you need one lot. Now, verify, is one lot within your account's cap for this asset? If your firm's cap is 24 lots for Forex on a $100,000 account, then yes, you're absolutely fine. The key principle is this: size by risk, not by maximum available lots. Then verify compliance with caps. This two-step process ensures you're both managing risk appropriately and staying within regulatory limits. Never push up against the lot caps simply because you can. Professional traders typically use a fraction of their available lot size because they prioritize capital preservation over maximizing position size. Remember, you make money by surviving, not by using every bit of available leverage. Expert advisors, commonly abbreviated as EAs, and automated trading systems represent a fascinating intersection of trading strategy and technology, but their use in prop trading is heavily regulated. Policies vary enormously across firms. Some are fully permissive, allowing EA usage without restrictions. You're free to automate as you wish. Others require EA registration and approval before use. You must submit your strategy details, configuration settings, and often the EA code itself for review. Some firms restrict certain strategy types: high-frequency trading, tick scalping, and various arbitrage EAs are commonly prohibited. And some firms simply ban all automated trading systems entirely. If your firm requires registration, here's what you'll typically need to provide: a detailed description of your strategy and its logic, your configuration settings and parameters, identifiers for the EA, its name, version number, and perhaps even the source code. The firm wants to understand exactly what your EA does and ensure it complies with all their rules. Common prohibitions on EA strategies include high-frequency trading, systems executing hundreds or thousands of trades per second, tick scalping, extremely rapid trades exploiting minor price movements, and latency or arbitrage-based systems that attempt to exploit feed delays or price discrepancies between brokers. Here's the critical compliance point: using an EA on a funded account without registration and approval can result in immediate account termination and profit forfeiture. Even if your EA is profitable, if it's unapproved, you risk losing everything. Furthermore, your EA must comply with all other trading rules: drawdown limits, news trading restrictions, lot size caps, prohibited strategies. Just because it's automated doesn't exempt it from the firm's regulations. My recommendation is this: log your EA parameters and version numbers meticulously. If you update your EA, even minor tweaks to parameters, resubmit it for approval if your firm requires this. Document everything. Keep records of your submissions and approvals. And finally, test your EA thoroughly on demo accounts before using it in evaluations or on funded accounts. Ensure it respects drawdown limits, doesn't trade during news blackouts, and stays within lot caps. An EA that violates rules, even unintentionally due to a coding error, can destroy your account just as quickly as manual trading mistakes. Automation doesn't reduce your responsibility, it increases it. Copy trading rules govern whether and how you can replicate trades across multiple accounts. This is an area where firms are extremely vigilant, employing sophisticated detection systems. Internal copying refers to copying trades between your own accounts, those registered under your own name with the same firm. This is often allowed, though with specific restrictions. Many firms limit the number of accounts that can be linked. For example, Apex allows 20 accounts, whilst Take Profit Trader permits only 3. The typical structure is a master-slave configuration. You designate one master account that executes your primary trading strategy, and those trades are automatically replicated to slave accounts, your other linked accounts. This system allows traders to scale their operations once they've proven profitability. External copying, however, copying trades from other traders or from external signal services, is typically banned outright. Firms want to fund your trading skills, not someone else's. If you're simply mirroring another trader's decisions, you're not demonstrating genuine competency. Now, how do firms detect unauthorized copy trading? They employ remarkably advanced algorithms that analyze multiple factors: trade frequency and timing. Are you executing the exact same trade at the exact same millisecond as another account? Position size and lot size. Are your trades identical in size to another trader's? Timing correlations. Do your trades consistently occur within seconds of another account's trades? And execution details. Are your entry prices, stop losses, and take profits matching someone else's with suspicious precision? If the system detects identical trades across accounts with matching lot sizes and timing, it's rather obvious what's happening. The consequences can be severe: account suspension whilst the firm investigates, permanent bans if copy trading is confirmed, and profit clawbacks. They'll reverse any payouts you've received. My advice is straightforward. If you want to copy trade between your own accounts, ensure it's explicitly permitted by your firm, and register all accounts properly. Provide transparency. Don't try to hide the connections. And absolutely never attempt to copy trades from external sources or other traders. The detection algorithms are far too sophisticated, and the risk simply isn't worth the reward. Trade with your own strategy, your own analysis, and your own decisions. That's what prop firms are paying for. Hedging policies determine whether you can hold opposing positions simultaneously. This is nuanced territory, and the rules vary significantly across firms. Let's clarify the 3 types of hedging you need to understand. First, internal hedging, also called hedging within the same account. This means opening both buy and sell positions on the same asset within a single account. Some firms like FTMO explicitly allow this. It's a legitimate risk management technique where you might go long on Euro-USD with one position, whilst simultaneously holding a short position to hedge against adverse movements. Other firms prohibit it entirely. You must verify your specific firm's policy. Second, cross-account hedging. This is where you execute opposite trades across multiple of your own accounts. For example, going long on account 1 and short on account 2 for the same asset at the same time. This is strictly prohibited by virtually all prop firms. Why? Because it creates what's called a risk-free profit scenario. If Euro-USD moves up, account 1 profits, whilst account 2 loses. If it moves down, account 2 profits, whilst account 1 loses. Either way, you've essentially eliminated market risk at the firm's expense, and one account will pass whilst the other fails. This violates the fundamental principle that traders must accept genuine market risk. Third, group hedging. This involves coordinating opposing positions with other traders across firms. Perhaps you and a colleague agree that you'll go long whilst they go short, hedging each other's risk. This is banned as arbitrage and market manipulation. Firms can detect these patterns through timing analysis and correlation studies across their entire trader base. The rationale for these prohibitions is quite logical. Cross-account and group hedging undermine real market functioning. Prop firms are funding traders who can generate alpha, genuine market-beating returns through skill and analysis. They're not funding traders who are simply gaming the system to eliminate risk artificially. carefully. Violations result in severe consequences. Immediate account termination across all your accounts. Profit forfeiture. They'll claw back any payouts you've received. And potential permanent bans from the platform. My recommendation? If you need to hedge for legitimate risk management purposes, do so within a single account if your firm permits internal hedging. Document your rationale clearly, but never, under any circumstances, hedge across multiple accounts or coordinate with other traders. The sophisticated monitoring systems will detect these patterns, and the consequences are severe and permanent. Now we come to prohibited trading strategies, the activities that will get your account terminated faster than you can blink. Pay extraordinarily close attention to this section. First on the list, high-frequency trading, or HFT, and latency arbitrage. These involve using algorithms to execute trades at extremely high speeds, often hundreds per second, exploiting data feed delays. One particularly egregious example is latency arbitrage, where traders exploit the time delay between trade execution and market data receipt. This isn't trading, it's technical exploitation of system inefficiencies. Second, arbitrage trading. This means exploiting price discrepancies between markets or brokers to profit without accepting market risk. For instance, if Euro USD is quoted at 1.1800 on broker A and 1.1805 on broker B, an arbitrage trader simultaneously buys on A and sells on B, pocketing the 5-pip difference with zero market exposure. Violations result in immediate challenge disqualification or funded account termination, with permanent platform bans. Third, tick scalping. This involves making extraordinarily quick trades, often lasting just fractions of a second, to profit from minor price changes. Some firms require that at least 50% of your trades exceed 1 to 2 minutes in duration to prevent tick scalping. If you're consistently in and out within seconds, you're likely violating this rule. Fourth, martingale trading, also known as doubling down. This gambling-like strategy involves increasing your lot size after each loss, hoping that an eventual win will recover all previous losses. This strategy is catastrophically dangerous and can lead to account blow-ups. It's explicitly prohibited because it resembles gambling, not trading. Fifth, grid trading. This involves placing multiple buy and sell orders at similar price levels simultaneously, creating a grid of pending orders. This risks market manipulation and over-leveraging, and it's banned at most firms. Sixth, reverse trading or group hedging. We discussed this earlier, executing opposite trades on the same asset across multiple accounts to minimize risk. And seventh, dollar cost averaging into losers, sometimes called DCA. This means continuously opening additional positions in the same direction as your losing trades move against you, averaging down your entry price. This is essentially throwing good money after bad and is prohibited. There's also account rolling, purchasing multiple evaluation challenges and using high-risk strategies across all of them, replacing failed accounts with new ones. This gaming of the system is banned. The consequences for engaging in these prohibited strategies are severe and immediate. Disqualification from challenges, account resets forcing you to start over, termination of funded accounts, profit removal. They'll void all your gains from prohibited trades, and permanent bans, preventing you from ever returning to that firm. The message is crystal clear. Trade legitimately. Use sound technical and fundamental analysis. Manage your risk properly. Accept genuine market exposure. That's what prop firms are paying for, not clever system exploitation or gambling masquerades. Professional trading requires skill, discipline, and integrity. Prohibited strategies demonstrate none of these qualities. Gambling and reckless trading behaviors are strictly prohibited because they fundamentally contradict what professional trading represents. Let me be absolutely clear. There's a world of difference between calculated risk-taking and reckless gambling. What constitutes gambling behavior in the context of prop trading? First, over-leveraging. This means using most or all of your available margin on single trades, leaving your account highly exposed to even small adverse market movements. If you're regularly using 70, 80, or 90% of your available leverage, you're not trading, you're gambling. Second, one-sided bets without thorough analysis. Going heavily long or short based on gut feelings, tips from social media, or pure speculation, rather than sound technical or fundamental analysis. Professional traders have reasons, documented, logical reasons for every position they take. Third, hyperactive trading, making far too many trades in short periods, executing impulsively without proper planning. If you're churning through dozens of trades daily without clear strategies, you're exhibiting gambling behavior, not disciplined trading. Fourth, all-in strategies, placing large portions, or worse, all of your account balance on single trades without proper risk management. Professional traders typically risk 1 to 2% per trade, perhaps 3% maximum. If you're risking 20, 30, 50% on a single position, that's not risk management, that's roulette. Fifth, doubling down after losses. Increasing your position sizes after losing trades in an attempt to recover quickly. This is the martingale strategy we discussed earlier, and it's a classic gambling behavior that leads to catastrophic losses. And sixth, what traders call punting, placing a small number of very large, high-risk trades, hoping for quick profits without any clear strategy or analysis. It's the trading equivalent of going to a casino and putting everything on red. How do firms enforce these prohibitions? Through progressive discipline systems. Your first offense typically results in warnings, formal notifications that your behavior is concerning. Second offenses may lead to profit deductions. They'll reduce your account balance or void gains from reckless trades. Third offenses can result in account restrictions, limiting your leverage, position sizes, or trading instruments. And repeated or severe violations lead to account resets, forcing you to restart your evaluation, or permanent termination. The fundamental principle here is this: prop firms are seeking professional traders who demonstrate consistent, disciplined, risk-managed trading behavior. They're not looking for gamblers who occasionally get lucky. If you cannot distinguish between calculated risk-taking and reckless gambling, you have no business trading with other people's capital. My advice? Before every trade, ask yourself 3 questions. What's my analysis? What's my risk? What's my plan if I'm wrong? If you can't answer these clearly and rationally, don't take the trade. It's that simple. Professional trading is boring, methodical, and disciplined. If you're seeking thrills and excitement, go to a casino. Don't waste your time and money on prop firm evaluations. Payout and withdrawal rules determine when and how you can actually receive your hard-earned profits. This is, after all, why we're here: to make money. So understanding these rules is absolutely crucial. Payout frequencies vary enormously across firms. Some firms allow payouts after just 8 trading days, provided you've met specific criteria, typically requiring 5 days showing at least $50 profit each. Others operate on 10 business day cycles. Some use 14 calendar day or bi-weekly schedules. Traditional firms still use monthly payout structures, and the most progressive firms offer on-demand payouts, approving requests instantly or within 6 to 12 hours. These are brilliant if you need quick access to your profits. What requirements must you meet before requesting a payout? First, minimum trading days. Often you need 3 to 5 winning days with minimum daily profit thresholds, perhaps $50 per day, or a certain percentage of your account. This ensures you're demonstrating consistency, not just one lucky week. Second, minimum withdrawal amounts. Most firms set floors at $250 to $1,000. You can't request a payout for $20. It must reach the minimum threshold. Third, maximum withdrawal limits. These are often tiered based on your account size and which payout number this is. Your first payout might be capped at $2,000, your second at $5,000, and subsequent payouts might have higher or even unlimited caps. Fourth, consistency rule compliance. You must meet the consistency rule we discussed earlier before requesting payouts. If your best day represents too large a percentage of your total profit, your payout request will be denied. until you generate more balanced profits. And fifth, safety net requirements. For your first few payouts, typically the first 3, your account balance must exceed your drawdown limit plus a buffer. This ensures the firm isn't paying you out whilst your account is dangerously close to breaching. Here's a practical example using Apex Trader Funding's rules. After 8 trading days, with 5 days showing $50 or more profit, you can request your first payout. However, your best day's profit must not exceed 30% of your total profit due to their consistency rule, and your account must maintain sufficient buffer above the drawdown limit. Only after meeting all these conditions will your payout be approved. My recommendation: track your payout eligibility metrics daily. Know exactly how many profitable days you have, what your best day was, what your total profit is, and whether you meet the consistency threshold.
Don't wait until you want to withdraw to discover you don't qualify. Plan your payout strategically and always maintain compliance with all rules. The last thing you want is to generate substantial profits only to have your payout denied because you violated some seemingly minor requirement. Understand your firm's specific payout policies inside and out. These rules aren't negotiable, and ignorance is not an excuse. Know when you can withdraw, how much you can withdraw, and what you must do to qualify. Your ability to actually receive your profits depends entirely on understanding and following these rules. Profit split structures define how your trading gains are divided between you and the firm. This is absolutely fundamental to your earning potential, so pay very close attention. The ranges you'll encounter typically fall into 4 categories. First, 50 to 60% splits. This is the lower end, more common with older or stricter firms. Whilst not terrible, it means the firm is taking 40 to 50% of your hard-earned profits. You're essentially splitting your gains nearly down the middle. Second, 70 to 80% splits. This is the middle ground and is considered quite solid and fair. Most competitive firms operate in this range. You're keeping the majority of your profits, whilst the firm takes a reasonable share for providing the capital and infrastructure. Third, 80 to 90% splits. These are higher splits, offered by very competitive firms trying to attract top talent. If you can secure an 85 or 90% split, you're doing exceptionally well. You're keeping nearly all of your profits. And fourth, 90 to 100% splits. These are top-tier splits, sometimes approaching 100% of profits to the trader. However, be cautious. Firms offering these extraordinary splits typically compensate through higher challenge fees, monthly platform fees, or tighter trading rules. Nothing is truly free in this business. Now, let's discuss the various profit split models you'll encounter. Fixed splits maintain the same percentage regardless of your performance. For example, an 80-20 split means you always keep 80%. The firm always takes 20%. It's simple, predictable, and transparent. Tiered splits improve as you hit profit milestones. You might start at an 80-20 split for your first $10,000 in profit, then improve to 85-15 after reaching $25,000, and finally reach 90-10 after $50,000. This rewards consistent profitability and incentivizes you to keep trading with the firm. Scaling-based splits improve as your account scales upward. When you're trading a $50,000 account, you might have an 80% split. When you scale to $100,000, it improves to 85%. At $200,000, perhaps 90%. The firm is acknowledging that larger, more successful traders deserve better terms. What are the trade-offs to consider? Higher splits often come with stricter rules or higher costs. A firm offering a 95% split might have very tight drawdown limits, expensive challenge fees, or mandatory monthly subscriptions. You must evaluate the total cost of trading, not just the profit split in isolation. My recommendation is this: don't choose a firm based solely on the profit split percentage. Consider the complete package: challenge costs, evaluation difficulty, rule strictness, payout frequency, and, yes, the profit split. An 80% split with reasonable rules and quick payouts is often far better than a 95% split with draconian restrictions and monthly payout delays. Evaluate firms holistically. Calculate your expected net earnings after all fees and costs. That's what truly matters. Not the headline percentage, but what you actually pocket at the end of the day. Time limit policies affect how long you have to complete evaluation challenges. This might seem like a minor detail, but it profoundly impacts your trading psychology and strategy. Traditional time limits typically range from 10 to 30 days per evaluation phase. You must hit your profit targets within this time frame, or you fail and must restart. These deadlines create pressure, sometimes productive pressure that keeps you focused, sometimes counterproductive pressure that leads to overtrading and poor decisions. The contrasting approach is unlimited time evaluations, where firms impose no deadline whatsoever. You can take 1 month, 3 months, 6 months, however long you need to meet the profit target whilst maintaining rule compliance. You're still required to meet minimum trading day requirements and rule compliance, but the calendar isn't ticking down relentlessly. What are the benefits of no time limit evaluations? First and foremost, they reduce pressure and stress tremendously. You're not constantly watching the calendar, worrying that you're running out of days. This allows for clearer thinking and better decision-making. Second, they support all trading styles, from scalping to swing trading. If you're a swing trader who holds positions for days or weeks, traditional 30-day time limits are punishing. With unlimited time, you can trade according to your strategy, not the calendar. Third, they encourage quality over quantity in trade selection. With no deadline, you can wait patiently for your highest probability setups, rather than forcing trades just to make something happen before time runs out. Fourth, the absence of deadline pressure improves decision-making quality. You're trading based on your analysis and strategy, not on panic about running out of time. And fifth, they maximize success rates. Data consistently shows that traders with unlimited time have higher evaluation pass rates because they're not making desperate, time-pressured decisions. However, even with unlimited time, you still must meet all other requirements: minimum trading days, profit targets, drawdown limits, and rule compliance. The only difference is the absence of a calendar deadline. My perspective on this is quite clear. Unlimited time evaluations are generally superior for most traders. Time pressure rarely improves trading performance. It usually degrades it. If you have the option between a firm with time limits and one without, all else being equal, choose the one without. However, be honest with yourself. If you're the type who needs external pressure to stay disciplined and focused, perhaps time limits help you. But for most professional traders, unlimited time simply allows them to trade properly, without artificial constraints that have nothing to do with actual market conditions or trading skill. Evaluation models determine the pathway you must follow before receiving funded capital. Different firms use different structures, and understanding these is crucial for choosing the right firm. Let's examine the 4 primary models. First, one-phase evaluations. This is the simplest structure: a single profit target, typically 8 to 10%, with all standard risk rules applied. Hit the target without breaching, and you're funded. These attract more beginners because they're straightforward and psychologically less daunting. Success rates tend to be higher simply because there's less to navigate. However, some firms compensate for the simplicity with slightly stricter rules or lower profit splits. Second, two-phase evaluations. This is the most common model in the industry. Phase 1 requires a higher profit target, typically 8 to 10%. Serving as the primary skill demonstration. Phase 2 then requires a lower verification target, around 4 to 5%, designed to confirm your Phase 1 performance wasn't merely luck. Each phase maintains the same risk management rules, but the reduced target in Phase 2 acknowledges that you've already proven basic competency. This model strikes a balance between thoroughness and accessibility. Third, multi-phase evaluations. Some firms implement 3 or more phases with progressively lower targets at each stage. For instance, Phase 1 might require 10%, Phase 2, 5%, and Phase 3, 3%. These emphasize consistency across extended periods, requiring traders to demonstrate stable performance through multiple evaluation stages. They're more rigorous and time-consuming, but they also identify traders with genuine, repeatable skills, rather than short-term lucky streaks. And fourth, instant funding models. These bypass evaluation entirely. You pay a higher upfront fee and receive immediate access to a funded account. However, these typically come with stricter live account rules,
tighter drawdown limits, and often smaller starting allocations. The firm is taking greater risk by funding you without evaluation, so they compensate through other restrictions. What should guide your choice? If you're a beginner or want simplicity, one-phase models are your best option. They're less overwhelming, and you can focus on mastering the basics. If you're experienced and seeking industry-standard challenges, two-phase models are ideal. They're widely recognized, well-balanced, and most firms offer competitive terms with these structures. If you're highly confident in your consistency and don't mind extended evaluation periods, multi-phase models can work. Just ensure the time investment is worthwhile given the eventual funding terms. And if you're extraordinarily confident in your abilities and want immediate market access, instant funding might appeal to you. But scrutinize the terms carefully. Those higher fees and stricter rules can be punishing if you're not genuinely skilled. My recommendation for most traders? Start with one-phase or two-phase evaluations from reputable firms. Master those structures first. Once you're consistently passing and profiting on funded accounts, then consider whether more complex models or instant funding makes sense for your situation. Remember, the evaluation model is merely the gateway. What truly matters is your ability to trade profitably and sustainably once you're funded. Choose the model that best allows you to demonstrate your genuine skills, whilst managing the psychological and strategic challenges each structure presents. Violations and reset policies govern what happens when you breach rules and how you can recover from those breaches. Understanding these mechanisms is essential because, let's be honest, most traders will experience violations at some point. Let's clarify the types of violations you'll encounter. First, hard breaches. These result in immediate account termination. You've exceeded your maximum drawdown, violated a critical rule, or engaged in prohibited strategies. The account is dead. You must either purchase a full reset, essentially starting over as if you'd never taken the challenge, or repurchase an entirely new evaluation. There's no warning, no second chance. It's over the moment you breach. Second, soft breaches. These are less severe. The firm issues a warning, typically deducts a portion of your profits as a penalty, but your account remains active. You can continue trading. Think of it as a yellow card in football, serious enough to warrant action, but you're still in the game. However, accumulating multiple soft breaches usually escalates to a hard breach. Third, progressive discipline systems. Some firms employ a three-strike approach. Your first violation receives a warning, a formal notice that you've done something wrong. Your second violation might result in profit deductions or temporary restrictions. Your third violation triggers a hard breach and termination. This system rewards learning from mistakes, whilst still maintaining accountability. Now, what about reset options? Many firms offer cost-effective resets, ranging from roughly $77 to $477, depending on your account size. This is far cheaper than purchasing an entirely new evaluation. The firm essentially restores your account to its starting state. Same balance, same rules, fresh opportunity. These resets typically happen within minutes, so you're not waiting days to restart. Some progressive firms even offer free retakes under specific conditions. If you've met minimum trading day requirements but simply didn't reach the profit target, you didn't breach, you just didn't profit enough. They'll let you try again at no cost. This is generous and recognizes that not every evaluation failure is due to poor risk management. What are the common violations that trigger these mechanisms? Exceeding drawdown limits, whether daily, overall, or trailing, is the most frequent cause. Engaging in prohibited strategies like HFT, arbitrage, or tick scalping will get you terminated immediately. News trading violations during blackout windows often result in soft breaches initially, but repeated violations lead to hard breaches. And gambling behaviors, over-leveraging, all-in strategies, martingale trading, result in progressive discipline or immediate termination depending on severity. My advice for navigating violations? First, understand your firm's specific violation and reset policies before starting. Know what constitutes a hard breach versus a soft breach. Know your reset costs and options. Second, If you receive a soft breach warning, take it extraordinarily seriously. This is your opportunity to correct your behavior before facing permanent consequences. Review what you did wrong, adjust your strategy, and don't repeat the mistake. Third, if you hard breach, don't panic. Evaluate whether a reset makes sense. If you breached due to a genuine mistake or temporary lapse in discipline, a reset might be worthwhile. If you breached because your strategy is fundamentally flawed or you don't understand the rules, purchasing a reset is throwing good money after bad. Fix your approach first. And finally, track your performance metrics constantly. Know where you stand relative to all limits at all times. Most violations happen because traders aren't monitoring their accounts carefully enough. They drift closer and closer to breach thresholds without realizing it. Then one bad trade pushes them over the edge. Vigilance prevents this. Violations aren't moral failures. They're part of the learning process. But repeated violations indicate you're not learning. Use these mechanisms wisely. Learn from your mistakes and demonstrate the discipline and adaptability that professional trading demands. Scaling plans outline how you can increase your capital allocation after demonstrating consistent profitability and risk management. This is where successful prop traders truly build wealth, not just through profits, but through capital growth. Let's examine the three primary types of scaling plans. First, fixed percentage scaling. Your account increases by a predetermined percentage, often 25%, after reaching specific profit thresholds. For example, you start with a $25,000 account, generate 10% profit consistently whilst maintaining compliance, and the firm scales you to $31,250. Hit the next milestone, and you scale again. It's mechanical, predictable, and transparent. Second, performance-based scaling. Your capital allocation grows based on demonstrated consistent profitability over time. The firm isn't following a rigid formula. They're evaluating your actual trading performance, risk management quality, rule compliance, and profit consistency. If you're performing exceptionally well, they might scale you faster or larger than the standard percentage. If you're profitable but erratic, scaling might be slower. Third, tiered milestone scaling. This involves multi-level progression with increasing account sizes as you meet specific milestones. You might start at $25,000, scale to $50,000 after 30 days of compliant trading with 10% profit, then to $100,000 after another 60 days meeting similar criteria, eventually reaching $200,000 or more. Each tier has specific requirements you must satisfy before advancing. What are the common scaling requirements? First, reaching minimum profit targets, typically around 10% growth over the evaluation period. You must actually be making money, not just avoiding losses. Second, avoiding daily or avoiding loss limits for set periods, usually 30 to 60 days. You must demonstrate consistent risk management over extended timeframes. Third, maintaining proper risk management and position sizing throughout. The firm is watching how you trade, not just your results. Reckless trading that happens to be profitable won't qualify you for scaling. And fourth, remaining compliant with all firm rules. One violation can delay or disqualify you from scaling, even if you're profitable. Here's a typical scaling pathway. You begin with a $25,000 funded account, trade for 60 days, generate 10% profit, maintain perfect rule compliance, and you scale to $50,000. Trade another 90 days, demonstrate continued profitability and discipline, and you scale to $100,000. Continue performing, and you might reach $200,000 or even larger allocations over time. The beauty of scaling is that your earning potential grows exponentially. A 1% weekly return on $25,000 is $250, but 1% weekly on $200,000 is $2,000. Same skill, same strategy, 8 times the income. My recommendations for maximizing scaling opportunities? First, maintain consistency ruthlessly. Scaling rewards steady, reliable performance, not spectacular but volatile results. Aim for consistent 2 to 3% monthly returns rather than alternating between 20% gains and 10% losses. Second, avoid consistency rule violations. These often disqualify you from scaling eligibility, even if you're profitable. Balance your daily profits carefully. Third, maintain your risk per trade as your account scales. If you're risking 1% per trade on $25,000, that's $250. Continue risking 1% when you scale to $50,000. now $500. Don't dramatically increase risk just because your account is larger. And finally, communicate with your firm. Understand their specific scaling criteria, timelines, and approval processes. Some firms scale automatically, others require you to apply, know the system, and work within it. Scaling is how prop trading becomes a legitimate career rather than just a side income. It's the path from thousands to tens of thousands to potentially hundreds of thousands in capital allocation. But it requires patience, discipline, and consistent execution. Focus on these qualities, and scaling opportunities will follow naturally. Compliance and monitoring systems are the mechanisms through which prop firms enforce all the rules we've discussed. Understanding how you're being watched, and trust me, you are being watched very carefully, is essential to avoiding violations and maintaining your funded status. Let's examine the various monitoring methods firms employ. First, real-time tracking systems. Automated systems monitor your drawdown levels, lot sizes, position counts, and trading patterns continuously throughout each session. Every tick, every trade, every position adjustment is being tracked in real time. If your equity approaches a breach threshold, the system knows instantly. If you exceed lot size caps, it's flagged immediately. These systems don't sleep, don't take breaks, and don't miss anything. Second, daily reconciliation processes. After each session closes, typically at 5 o'clock Eastern Time, firms conduct comprehensive reviews. They reconcile your day's activity, verify all calculations, and catch any violations retroactively. Even if the real-time system didn't flag something during trading hours, the daily reconciliation will catch it. This is where end-of-day drawdown calculations occur, where trading day requirements are verified, and where daily profit thresholds are confirmed. Third, algorithmic detection systems. These are remarkably sophisticated programs analyzing trading patterns for suspicious activity. They identify potential copy trading by looking for identical trades across multiple accounts, same symbol, same lot size, same entry time, down to the millisecond. They detect unauthorized hedging by correlating opposing positions across your accounts. They flag arbitrage attempts by analyzing execution patterns and profit sources. These algorithms are constantly learning and improving, becoming more sensitive to manipulation attempts. And fourth, manual review processes. Before approving payouts or scaling requests, human trading experts often review your account history. They're checking consistency rule compliance manually because it requires nuanced judgment. They're evaluating whether your trading patterns seem legitimate or suspicious. They're ensuring you haven't engaged in any gray area activities that automated systems might miss. When breaches occur, firms provide detailed breach dashboards. These show you exactly when the breach happened, down to the precise timestamp. They display your equity curve leading up to the breach, so you can see how you drifted toward the violation. And many offer replay functionality, allowing you to watch your trades and equity movements play back to understand exactly what went wrong. Why are firms so vigilant? Several compelling reasons. First, capital protection. They're protecting their investment in you. Every funded trader represents real capital at risk. Second, fairness enforcement. They must ensure all traders are operating under the same rules. If some traders are cheating, whilst others follow the rules, the system collapses. Third, regulatory compliance. Many firms operate under financial regulations requiring robust monitoring and risk management systems. And fourth, scalability. To fund hundreds or thousands of traders simultaneously, firms need automated systems that can monitor everyone consistently and reliably. What does this mean for you as a trader? First, operate under the assumption that everything you do is being monitored, because it is. Don't attempt to exploit technicalities, push boundaries, or engage in questionable practices thinking you won't be caught. You will be caught. Second, if you're unclear whether something is permitted, ask before doing it. Contact your firm's support team, get written clarification, and document that clarification. Ignorance isn't an excuse, but but genuine confusion that you attempted to resolve demonstrates good faith. Third, maintain your own monitoring. Don't rely solely on the firm's systems to track your compliance. Monitor your own drawdown levels, trading day counts, consistency ratios, and all other metrics. Take personal responsibility for your compliance status. And finally, if you're flagged for a violation, respond professionally and promptly. If it's a genuine mistake, acknowledge it. Explain what happened, and demonstrate how you'll prevent it in future. If you believe it's an error by the firm, provide evidence calmly and professionally. The monitoring systems exist to protect both you and the firm. They ensure a level playing field and maintain the integrity of the prop trading ecosystem. Work with these systems, not against them, and compliance becomes straightforward. Your focus should be on trading profitably, whilst operating well within all boundaries, not on seeing how close you can get to the edge without falling off.
Well, ladies and gentlemen, we've reached the conclusion of our comprehensive journey through prop firm trading rules. Let's consolidate everything we've learned into actionable key takeaways that will serve you throughout your trading career. First and foremost, know your limits intimately. Master your daily, static, trailing, and end-of-day drawdown rules. These are your survival mechanisms. Know exactly where your thresholds sit at every moment. Track them obsessively. Most trader failures occur because of drawdown violations, not because of poor trading strategy. Respect these limits, absolutely. Second, pass smart, not fast. Hit your profit targets whilst meeting minimum trading day requirements and consistency rules. Don't rush to reach targets by overtrading or taking excessive risks. Slow, steady, compliant progress beats spectacular but rule-breaking performance every single time. Remember, it's not just about making money, it's about making money the right way. Third, size by risk, not by maximum availability. Respect lot caps and exercise leverage prudence. Calculate your position sizes based on your risk percentage, typically 1 to 2% per trade. Then verify you're within regulatory caps. Never use maximum leverage simply because it's available. Professional traders use a fraction of their available leverage because they prioritize survival over maximizing position size. Fourth, avoid the common traps that destroy accounts. Stay clear of news trading windows unless you're absolutely certain your firm permits it and you understand the rules perfectly. Never engage in prohibited strategies, no matter how tempting they might seem. Don't exhibit reckless gambling behaviors. Trade professionally, methodically, and with discipline. Fifth, get paid properly. Understand your payout cadence, profit splits, and safety buffer requirements. Know exactly when you're eligible to withdraw, how much you can withdraw, and what you must do to qualify. Don't generate profits only to discover you can't access them due to technicalities you didn't understand. Plan your payouts strategically. And finally, grow safely and sustainably. Follow scaling criteria meticulously. Maintain clean compliance records. Understand that scaling is how prop trading transforms from supplemental income into a genuine career. But scaling rewards consistency, discipline, and rule compliance, not spectacular but volatile performance. Here's my final synthesis of wisdom after everything we've covered. Prop trading isn't primarily about trading skill, though skills certainly matters. It's about operating successfully within a structured system of rules and regulations, whilst generating consistent returns. The best technical analyst in the world will fail if they can't follow drawdown limits. The most profitable trader will be terminated if they engage in prohibited strategies. Success in prop trading requires three components working in harmony. First, genuine trading skill and market understanding. Second, disciplined risk management and position sizing. And third, comprehensive knowledge and adherence to all firm rules and regulations. You've now been equipped with that third component. You understand drawdown mechanisms, profit targets, trading day requirements, consistency rules, leverage restrictions, position holding policies, news trading limits, lot caps, EA regulations, copy trading prohibitions, hedging policies, prohibited strategies, gambling behaviors to avoid, payout processes, profit splits, time limits, evaluation models,
violation consequences, scaling pathways, and compliance monitoring systems. That's comprehensive education. Use it wisely. My final recommendation? Read your specific firm's rules document 3 times before starting any evaluation. Highlight every requirement. Create a checklist. Monitor your compliance daily. Trade conservatively whilst you're learning the system. Only increase aggression once you're absolutely certain you understand all boundaries. Prop trading offers extraordinary opportunities for skilled, disciplined traders to access capital they couldn't otherwise obtain, but it demands respect for rules, systems, and regulations. Approach it with professionalism, discipline, and integrity, and it can be genuine, life-changing. Thank you for your attention throughout this comprehensive presentation. I wish you tremendous success in your prop trading journey. Trade wisely, trade safely, and above all, trade in compliance. Good luck. Thanks so much for watching today's video. I really truly appreciate you taking the time to tune in. It means the world to me. If you enjoyed it, make sure to follow me across all platforms so you don't miss any of the fantastic content coming your way. And remember to like and subscribe, as well as leaving your questions and comments. They are absolutely invaluable for future content ideas and refinement. Down in the description, you'll find links to the brokers I personally use, some brilliant backtesting software I highly recommend, and of course, our free Discord community, where you can connect and learn alongside other passionate traders just like yourself. I'll leave you with one of my favorite verses, Exodus 14:14. The Lord will fight for you, and you shall hold your peace. And as always, remember, strive for progress, not perfection. I'll see you all in the next one. God bless.